Okay, so we have looked at how the definition and also the different types of forex risk, and as I said, we'll also look at now next the different ways or mitigation strategies for now mitigating against such forex risks. So but first, to now know how to, for example, even how to mitigate ourselves or hedge ourselves against the different types of forex risk that we'll have just looked at: translation risk, natural risk, and also transaction risk. Then let's look at how now we can measure now or even monitor such such currency and forex risk in our loan books as a bank or as a reserve bank. So we'll first go look at the value at risk. So the value at risk is basically now the compounding of the value of for example, assets or liability you hold in that foreign currency that is facing a risk by the Z score. The Z score is basically a confidence level at some scale. Okay, so it's basically the compounded measure, or the value at risk is the compounded measure of the risk exposure of the bank at some level due to the level of, for example, foreign currencies that is held, and therefore that it faces a forex risk at times some confidence level. So the confidence level, for example, can be, let's say, at a 1% confidence level, you are confident that, for example, the USD won't go or won't strengthen past, for example, 130 Kenya shillings. All right, so that's basically it. So it measures the potential, the worst case scenario at a confidence or at a risk level. Okay, that, for example, a current risk portfolio or currency will, due to adverse, or let's say if the currency in the adverse effect that it weakens against that foreign currency that you hold the portfolio, either loan or deposits in, then over the period of time, then it won't go, or it won't weaken past some price or point. Okay, so how do we calculate it? It's basically you compound the value of the foreign currency portfolio that you hold by the for example, the volatility as monitored, the past volatility. That's why foreign currency volatility monitoring is very, very key, and forex risk monitoring is very, very key by treasury departments of banks and reserve banks in this case. So by that confidence level, you multiply or you compound the confidence level and also the past volatility